Yo, what's going on, everybody? It is Wednesday, June 21st. Isn't that the beginning of summer, the official beginning of summer, the 21st or the 22nd? It might be today. Anyway, let's go over what's been going on. As I have been warning you for months now that June we were going to get a tax drain and we are going to see a pullback in the markets, and that's exactly what has been happening. But don't expect to hear that on the financial media or any of these financial analysts or economists. In their minds, everything has to be defined in the context of monetarism, and it has to do with the Fed. Like I saw the headlines today, and it was about Powell's testimony before Congress, and it was like, yeah, we're going to keep raising interest rates. Folks, let me tell you something. That the economy is making a fool out of the Fed and its interest rate policy, because we saw the other day a huge, well, it wasn't huge, but I mean it was a surprising increase in housing starts, and that was not expected. And so, they just don't get it. I was having a conversation with my sister the other day, and I was trying to explain this stuff to her. It's double entry accounting, man. It's just like, yeah, you raise interest rates, and there's going to be an effect from that, maybe negatively on debtors. But that's a massive, now we're talking about a massive fiscal injection, and you could see the numbers every week go up more and more and more and more and more. So the Fed is just absolutely clueless to this. The monetarists are absolutely clueless to this. They stick on their program of, we got to keep raising, we got to keep raising. They're like I said early on, way before this really started to get going, there are examples all over where you can look at rate hikes or rate cuts, and you could see the effect. These are either fiscal additions or fiscal subtractions. Actually, the rate cuts, you look at Japan, where they've kept rates negative and inflation is very low. And you look at the countries where they have been raising interest rates, and while inflation has come down because of the resolution of a lot of these pandemic and supply chain issues, also that's related to Biden's sanctions. There are elements within the inflation picture that are completely tied to the Fed. If you look at housing inflation, if you look at auto prices, if you look at things that are, highly leveraged when they're financed, that is completely a factor or a cause of the Fed. And they're just never going to get it. Just don't think that they're going to get it, because they're not going to get it. It's an orthodoxy that they stick with. It's a belief system that they stick with. And what do I care? For me, as I've always said, knowledge, information is power. That's an old saying, that's a cliche, but it's true. And that's the reason why, my portfolio was at an all-time record high. It took a pullback recently from, the last couple of days. So let's go over the numbers. In the last 3 days, we're talking about, Tuesday, Monday, there was no trading. Friday and Thursday, we had a 78 billion drain. All right. That reduced the fiscal deficit in June from 92 billion down to 18 billion, something like that right now. So that is an actual subtraction. That is not like these people who are freaking out and crying over QT, or what the Fed is doing with regard to monetary policy insofar as reducing reserve balances, which, by the way, reserve balances are still very, very high. QT, as I said a million times, that's an asset swap where you take in one form of a dollar, which is a reserve balance in the banking system, and you're swapping it out for government securities, which are not only dollar equivalents, they carry a coupon, they carry an interest rate, and so like there's no net change in the money or the financial assets of the economy. So they're all freaking out over this, and that's the only thing they know how to talk about, when in reality, they really don't know what they're talking about. And this is why I keep saying, like, if you don't understand MMT, and I've had this conversation with these very sophisticated stock analysts who are these bottom-up guys who, they crunch the numbers on financial statements. They're looking at free cash flow. They're looking at debt. They're looking at, all these things, which is great. I mean, these are all great metrics that you can focus on. But I mean, if you don't have the macro environment, I don't look at that stuff. I look at it in a basic form. If I want to isolate a stock, what you can do, if you understand the macro picture, is you're going to also understand at the same time that there are going to be sectors in the economy that are going to benefit, and other sectors that either won't benefit at all. They might be hurt, or they might benefit less. And that depends on where policy is, how policy is put together, and where the flows are going. So if you have that in your head, and you have an understanding of that, and you have an understanding of the macro picture, you don't need to be a financial analyst to pick stocks. I mean, you pick the big name companies. You pick them when they're down, and you pick them when the macro situation is positive. And I mean, that's the simplest way I can describe it to you. I mean, they have people on Wall Street getting paid a lot of money, these stock analysts who, they don't do that well. We've seen a lot of them give advice or recommendation to lighten up or, sell. And it's just that they don't have an awareness of the macro picture. They have an awareness of, what a financial statement looks like. But again, at the very best, okay, at the very best, a financial statement will give you current information. It's not going to tell you, I use the Mariners example again. You're out on the open ocean. I mean, you can't look at a chart of where you've been and then, know where you're going to go. You have to have a chart of where you're going to go and what direction you're going to go in and what conditions are in front of you. So I don't know, I talk about this a lot. For some of you, it resonates. For others, I don't know what you do actually. I mean, maybe you have a 401k or an IRA and you just keep it in there, and that's good too. I mean, the growth, and I think I said this maybe in my last video. Like, even if we're talking about average growth over the last 25, 30 years, GDP growth 2.7%. I mean, that's been enough to bring the stock market to these all-time level highs. And even if we stay in that frame, which is very possible because, even though the monthly spending flows now are very strong. You know, taxes are high. A small tax cut right now would create like a boom in the stock market, and it would cause a growth expansion in the economy that was significant. But they're not talking about that because they're all still paralyzed by like, hey, where are we going to get the money? You know, we can't do that. Or we got to cut the deficit and all this stuff, all this bull crap. And you know, the spending led to the inflation, which maybe there was some truth to that, but only because the whole freaking entire global supply chain was shut down because of the COVID. And then right after that, when things started to loosen up, you know, Biden went crazy with all these sanctions. So of course, if you disrupt the system like that, one was a disruption based on, you know, the pandemic. I don't know how necessary it was to disrupt everything, but that's what they did. That's what the leaders, the so-called leaders, did. And the other one was a disruption of, you know, kind of global commerce with all these sanctions, which are still in place. I mean, you take that away, and again, we'd be growing at 4 or 5. I mean, these monthly flows, think about it. These monthly flows are still at levels like that we're talking about 50% higher than what we saw during the Trump presidency, when the stock market was basically like, it was on fire and it was going up every day. I mean, the stock market now is going to go up, but it's pushing against some heavy resistance, and that's the, you know, continuation of these policies which impede global trade. And like I said in the past, we're literally watching a breakup of a trading system, a global trading system that has been around for, you know, 40, 50 years. We're literally watching that happen, and there's new trading blocks being created. There's new currency relationships being created. So it's interesting. You got to know what's going on. You can make money. I'm telling you, you could make money if that's what you want. I don't know. A lot of you, I think, you just want action. You want a stock that you want to buy today, and it's going to be up 1,000% tomorrow. I'm sorry, I'm not the guy for you. I'm not the guy for you. But if you want long-term gains and an understanding of economics and an understanding of MMT, then yes, I am your guy, and I'm the only economist out there in the whole entire world who actually I have a report. You know, what I do on MMT Trader, nobody else does. You could have, I don't care if it's Stephanie Kelton, I don't care if it's Warren Mosler, they're not putting out reports. They're tweeting once in a while about this policy or that. That's great, that's fantastic. But I have come up with an applied approach to MMT, and you know, it's up to you if you want it or not. Prices have been reduced. I'm trying to make it available to people, and so that's it. Anyway, that's it for today, folks. Coming to you from sort of sunny Florida, a little bit of clouds, but it's late. And it's been a very nice day, and I'll see you tomorrow. Bye.